Welcome to the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoan, and today we have a packed episode filled with the latest trends, developments, and news in the mortgage and real estate sectors. In this episode, we will dive into various topics, including mortgage consumer trends from 2019 to today, a reality check on housing affordability and rate cuts from Desjardins, and much more. So, let us get right into it with our first segment. In Canada's evolving housing market, it's essential for mortgage professionals and other industry experts to stay informed on how consumer behaviors and preferences shift over time. This is the main reason behind our annual Mortgage Consumer Survey. This year, for the first time, we've compiled data from our 5 most recent surveys to give you an overview of the top trends. The data is organized in comparison tables that track the changes from 2019 to 2024 and focus on key aspects of the home buying experience. Let us start with some key highlights. One interesting trend is the consistent renting period. The amount of time first-time buyers rent before purchasing has stayed stable, peaking in 2022, with 64% of home buyers renting for 5 years or less before buying. Another significant finding is the critical role of mortgage professionals. Mortgage professionals remain essential, with increasing consumer loyalty to their financial institutions. Excellent service was the top factor influencing the use of a lender. 83% of homebuyers chose their lender due to excellent service received in the past, while 81% selected their broker for the same reason. Growing homebuyer concerns are also something to note. Increasing numbers of buyers are worried about overpaying, with 62% experiencing this concern in 2024. This emphasizes the importance of professional guidance during the home buying experience. Understanding the homebuyer journey is crucial. Buying a home is a major financial decision. Our findings show that the amount of time first-time homebuyers spent renting before buying a home has remained relatively stable. Over the past 3 years, about 1/3 of homebuyers ended up spending more than they initially planned. Fewer homebuyers, however, are paying the maximum price they can afford. 46% of homebuyers paid the maximum price in 2023 and 2024, down from the 3 previous surveys. Consumer uncertainty is another important aspect. The home buying process can generate both excitement and uncertainty. Since 2019, a growing number of homebuyers are feeling uncertain or anxious. Paying too much for a home has been the top concern since 2019. The importance of mortgage professionals cannot be overstated. Mortgage professionals play a critical role in the home buying process. In recent years, we've noticed an increase in consumer loyalty to their financial institutions, with 83% of homebuyers choosing their lender due to excellent service. Overall satisfaction is also high, with 75% of homebuyers being satisfied with their lender and 72% with their broker. Real estate agents continue to be seen as the most valuable role in helping homebuyers through the process since 2019. In our 2024 survey, 34% of homebuyers said that their real estate agent was the most important person in the home buying process. In today's housing market, the topic of affordability is more crucial than ever. A recent analysis from Desjardins Economic Studies sheds light on why upcoming interest rate cuts may not provide the relief that many Canadian homebuyers are hoping for. The report examines housing affordability trends in Canada since 2009 and highlights the significant challenges faced by prospective homeowners due to surging housing prices and rapid interest rate hikes. While the Bank of Canada's rate cuts, expected in late 2024 or early 2025, might offer a glimmer of hope, Desjardins warns that the relief will likely be minimal. The Desjardins Affordability Index analyzed the potential declines in mortgage payments against anticipated increases in housing values due to lower interest rates. The findings suggest that any decrease in interest rates will be moderate, resulting in minimal mortgage payment relief. This benefit is further dampened by the expectation of rising housing values as interest rates fall. The analysis also took into account muted income growth, which further dampens the prospects for significant improvements in affordability. This combination of factors may help explain the ongoing migration from Ontario to Western provinces, particularly Alberta, where housing prices remain comparatively low and average household incomes are higher. Affordability is expected to remain a key issue in the next federal election. Some may propose extending the amortization period beyond the current 25 years as a potential solution. However, Desjardins warns against this approach, stating that it could worsen affordability in the long run. Rising housing values would negate the initial benefits of longer amortization periods, ultimately benefiting only a few short-term buyers before prices climb further. One of the factors often blamed for driving up housing demand is the rapid influx of international students and non-permanent residents. While Canada's immigration rate is high, Desjardins found that non-permanent residents primarily impact the rental market and have minimal influence on resale prices. However, reducing the number of non-permanent residents could have unintended consequences, such as a shortage of construction workers, further limiting housing supply and exacerbating the demand-supply imbalance. The report also simulated the impact of an 80s-style recession on housing affordability. While such a scenario might lead to price declines and lower mortgage payments, it would also result in massive layoffs and income losses. Desjardins echoes the stance of the Canada Mortgage and Housing Corporation, stating that increasing the housing supply is the only long-term solution to affordability challenges. To achieve this goal, Canada needs to build an estimated 5.8 million new homes in the next decade. In a recent turn of events, a condominium in Ontario sold at a significant loss, highlighting the unpredictable nature of the province's real estate market. The property, located in Oakville's Glen Abbey neighborhood, initially sold for $657,000 in February 2022. This was a period marked by cheaper borrowing rates and heightened demand, leading to sky-high home prices across Ontario. The condominium, a one-bedroom, one-bathroom unit, boasts an open-concept kitchen, a barbecue on the balcony, and access to a clubhouse gym and sauna. However, despite these appealing features, the property was put back on the market in May 2024 for $447,000. It eventually sold for $420,000, representing a staggering $237,000 loss, or a 36.1% decline from its original sale price just 2 years earlier. This case is not an isolated incident. Another property, a 3-bedroom, 2-bathroom apartment unit in Brampton, also sold at a substantial loss last month. After 9 failed attempts to sell, the apartment finally sold at a $238,000 loss. These examples underscore the volatility and unpredictability that currently characterize Ontario's real estate market. According to the Canadian Real Estate Association, May 2024 continued to be a relatively uneventful month for many Canadian housing markets, with national month-over-month home sales edging slightly lower. Sean Cathcart, the senior economist at the Canadian Real Estate Association, noted that May was another sleepy month for housing activity in Canada, although it may prove to be the last of those now that interest rates have moved lower. In some housing markets, slower activity has given prospective buyers more room to negotiate lower prices. Home sales activity recorded over Canadian multiple listing service systems dipped 0.6% between April and May 2024, remaining slightly below the average of the last 10 years. This slower activity is a key factor in the recent sales at significant losses, as buyers have more leverage to negotiate prices down. In a surprising turn of events, Canadian bond yields have sharply rebounded after a 2-month downward trajectory. Government of Canada bond yields, which significantly influence fixed mortgage rates, have surged more than 30 basis points, or 0.3%. As of Tuesday, the 5-year Government of Canada bond yield, which moves inversely to bond prices, broke back above 3.6%, marking a 2-week high. Similarly, in the United States, the 10-year Treasury yield rose to its highest point since mid-June. Several factors are contributing to this sudden rise in bond yields. One key reason is the political climate in the United States. U.S. President Joe Biden's performance during last week's presidential debate may have led investors to anticipate a higher chance of former President Donald Trump winning the upcoming November presidential election. This has added more pressure on treasuries. Thierry Wisman, a global forex and rates strategist at Macquarie Group, explained, "For a variety of reasons having to do with fiscal policy, tariff policy, and immigration policy, we do believe that a prospective Trump administration in 2025-2028 will be more inflationary than a Biden administration." Additionally, comments by Federal Reserve Chair Jerome Powell have supported a potentially higher for longer interest rate outlook. While expressing satisfaction with the progress on inflation over the past year, Powell stated that he wants to see more substantial evidence before feeling confident enough to start cutting interest rates. "We want to be more confident that inflation is moving sustainably down toward 2% before we start the process of reducing or loosening policy," he said. As we have discussed in previous episodes, Canadian bond yields, and to some extent, mortgage rates are significantly influenced by economic conditions and developments in the United States. This current rise in bond yields is a prime example of that relationship. What does this mean for fixed mortgage rates in Canada? After witnessing considerable reductions in fixed mortgage rates over the past few weeks, some experts believe that these rate cuts will pause for the time being. Rate expert Ryan Sims noted, "Definitely the rate drops will stop. But if we see the bond yield hit 3.6% and hold, I would think you would see at least the uninsurable creep up a bit." Ron Butler of Butler Mortgage added, "Rates are going up as I type this, indicating that the big banks are becoming less aggressive in their discretionary pricing." However, Butler also mentioned that the ultimate trend for fixed mortgage rates will be downward, although it will not be a linear path. So what would it take to get bond yields and mortgage rates back on a downward trajectory? According to Sims, we would need to see inflation come way down in order to bring rates down. Every month that inflation remains higher than anticipated pushes bond yields up, making it more challenging to lower mortgage rates. For now, it appears that it will take some time for inflation to edge back towards the Bank of Canada's desired 2% neutral target. In May, Canada's headline inflation rate rose back to 2.9% from 2.7% in April. BMO chief economist Douglas Porter described inflation as being on a bumpy path going forward. This situation is also likely to delay rate relief for variable rate mortgage borrowers, whose rates are directly tied to the Bank of Canada's monetary policy decisions. While markets had previously expected a second quarter-point rate cut from the central bank at its upcoming July meeting, forecasts now suggest that a September rate cut is more plausible. Another key economic indicator to watch will be the upcoming release of employment data in both Canada and the United States. Bruno Valco, Vice President of National Sales for RMG, wrote in a note to subscribers, "The market consensus is for a continued rise in our unemployment rate to 6.3%. In my opinion, we desperately need relief in the form of lower interest rates." Now, let us discuss a significant development that could have a considerable impact on first-time homebuyers in Canada. Last week, 2 months after the Liberal government moved to introduce 30-year amortization for insured mortgages, the Canada Mortgage and Housing Corporation announced that it will boost its premium for this type of mortgage by 20 basis points. Starting August 1st, Canadian first-time homebuyers purchasing a newly built home for less than $1 million with a down payment smaller than 20% will be able to opt in to an insured 30-year amortization period, up from a 25-year maximum, with the additional 0.2% premium hike. According to Finance Minister Chrystia Freeland, this new mortgage policy was designed to make home ownership more tenable for young Canadians by curbing monthly mortgage costs. However, the strict eligibility requirements and the Canada Mortgage and Housing Corporation's recent premium hike have cast doubts on the true benefit of the new policy for housing affordability. Samantha Power, an Ontario-based mortgage broker, argues that the higher premium on mortgage insurance, which protects lenders in case of mortgage default and is mandatory when buyers can make less than 20% in a down payment, is just the tip of the iceberg. It isn't a massive difference, but it's still an increase. If we're trying to help first-time home buyers, why are we gouging them with an insurance premium? The bigger problem, says Mr. Power, is the strict criteria to qualify for the 30-year insured mortgage, which will exclude many Canadians trying to access the resale market and limit many qualifying buyers to the condominium market. This is strictly for first-time home buyers purchasing new builds. I don't know any new builds around me, around the Greater Toronto area for less than $1 million. In Ontario and British Columbia, the criteria will firmly exclude anyone except condominium buyers, says James Laird, Chief Operating Officer of RateHub.ca, a mortgage comparison platform. There are no newly built single-family homes under $1 million in the big cities, he said. RateHub's calculations show that home buyers who do fulfill the eligibility criteria will qualify for 6 to 7% more in mortgage loans with the new 30-year amortization, which is not a trivial amount. On a $400,000 loan, the difference in monthly payments between a 30 and 25-year mortgage amortization would be about $200 a month, says Mr. Laird. I would call that significant. That's a full grocery shop for a family. But there's just one problem, says Mr. Laird. Those who qualify would be limited to new construction homes, meaning their dollars won't go as far. The price per square foot of a new build is significantly higher than the price per square foot of a resale, said Mr. Laird. So even though you qualify for more money, your dollar actually doesn't go as far. For condominiums in particular, Ms. Carterain, Power says buyers will also need to factor in additional condo fees on top of the higher purchase price for new constructions. Despite the possible pitfall of dishing out higher interest payments over time, mortgage broker Ron Butler believes 30-year amortizations should be available across the board, as they make monthly payments more manageable for Canadians. These mortgages do not always need to come with significantly higher interest accumulation or lower home equity, he says. The idea that by increasing the mortgage to 30 years you're adding so much interest, that makes an assumption that no one chooses to make prepayments or to reduce the amortization down the line, says Mr. Ian Butler. You can make lump sum payments up to 20%. You can increase your mortgage. There are lots of things people do. As it stands, said Mr. Butler, the few mortgage seekers who would meaningfully benefit from the new policy are those in the prairies and the Maritimes. In these regions, new builds might actually meet the under $1 million threshold and include some single-family homes, although the caveat is that new builds are rare in places like the Maritimes. In addition, these parts of the country are not the ones facing the worst affordability crisis. In Royal LePage's 2024 ranking of Canada's most affordable real estate markets, cities such as Edmonton, Red Deer, Alberta, and St. John topped the affordability index. In Edmonton, for example, the median housing price in the first quarter of 2024 was $442,200, which aligns with Alberta's median household income of $95,900. In Toronto and Vancouver, the same housing price measure was well above $1 million, with median household income in the mid-$80,000 range, according to Statistics Canada. It is also worth mentioning that Toronto saw a dramatic drop in new-build condominium construction this year, with a 52% decrease from last year, according to an April report from Urbanation. Damien Charbonneau, co-founder of Nesto, a Canadian digital mortgage lender based in Montreal, said he could narrow down the number of his clients who would benefit from the new mortgage scheme to about 1%. While he sees the policy as a move in the right direction, he says it would make a bigger impact if the $1 million threshold was indexed to something like the rate of inflation. Anya Ettinger, a Toronto-based real estate agent who often works with first-time homebuyers, says many are also put off by new builds, not just because they're more expensive, but because of the flurry of negative media. You're seeing reports now of tons of new build scams, or they cancel projects. People are more weary of purchasing pre-construction, she says. Steve Pomeroy, a McMaster professor specializing in housing policy research, says that all things considered, extending amortizations to 30 years for insured mortgages is a positive initiative that should be seen as part of a systemic approach to making housing accessible. It should include stimulating supply while dealing with excessive demand, he said. He pointed to complementary initiatives such as Minister Freeland's additional announcement in April that first-time homebuyers will be able to pull up to $60,000 from their registered retirement savings plans to use in a down payment on a home, up from $35,000. Benjamin Reitzes, an economist with the Bank of Montreal, says that there are inconsistencies in the market that simply cannot be addressed with something like the new mortgage legislation. If we continue to get the population growth we had over the past few years, it continues to create upward pressure, says Mr. Reitzes. 30-year amortization or anything like it won't be a silver bullet. What has driven the problem is lots of demand. Meanwhile, Michigan Power feels like the policy is a missed opportunity. In the grand scheme of things, who are we helping here? Home buyers or just the developers? That wraps up this episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found today's discussions insightful and informative. As always, stay tuned for more updates and expert analysis on the ever-changing landscape of Ontario's mortgage and real estate market. Thank you for joining me, and until next time, take care and stay informed.